The unthinkable is not that gold and silver could rise violently. The unthinkable is that most people will still be positioned for the exact opposite world when it happens. That is the real danger. When an energy shock hits, ordinary investors do not usually lose because they missed one headline. They lose because they still believe the system they were trained to trust. Stocks for growth, bonds for safety, cash for patience will behave normally while the price of energy is tearing through the floorboards of the economy. That is a mistake. They think this is another news event. It is not. It is a repricing event. And repricing events do not politely wait for people to emotionally prepare. That is what history keeps showing. So, let me give you the one mother line that everything in this story serves. When energy supply is threatened hard enough, inflation returns. Paper wealth gets squeezed, and hard assets are suddenly revalued from background holdings into survival assets. That is the line. Not one war headline, not one spike in oil, not one dramatic chart. Transmission. Because once you understand that, 1973 stops looking like ancient history and starts looking like a user manual. Cheap energy creates complacency. A geopolitical rupture weaponizes oil. Inflation enters daily life. Central banks lose room. Stocks and bonds both become vulnerable. The public gets trapped in paper. Hard assets stop looking old-fashioned and start looking like the one thing in the room not built on promises. That is the sequence. Now, let me show you the mechanisms. The first mechanism is choke point shock. Most investors still think supply shocks begin when oil physically disappears. That is too late. The market starts repricing the moment the route becomes unreliable enough that the flow can no longer be trusted. If one major maritime choke point carries a massive share of the world's oil and gas, then even partial disruption turns into a global economic event. Insurance costs rise, freight hesitates, physical buyers scramble, traders run shortages, nations rethink reserves, everything becomes more expensive before the tap is formally declared dry. That is choke point shock. This is why these events never stay confined to tankers and charts. The route is strategic, but the effect is universal. Oil is upstream of transport, fertilizer, food, plastics, chemicals, heating, cooling, manufacturing, and logistics. So when the choke point becomes unstable, the cost structure of ordinary life starts shifting immediately. That is the first thing the public misses. They think they are watching a regional conflict. They are watching a global input being repriced. That is choke point shock. Now, let us move to the second mechanism. I call it inflation reentry. A lot of people still behave as though inflation is a problem that appears in reports. It is not. It appears in systems. That is inflation reentry. When energy costs surge, companies do not absorb all of it out of kindness. Transport gets more expensive, food gets more expensive, industrial production gets more expensive, utilities get more expensive. Suddenly, the whole inflation story that central banks and markets were trying to cool begins pushing back in the other direction, and this is where the real danger begins. Not because inflation is mysterious, but because policy becomes trapped. That is the point. If inflation was supposed to keep falling and then energy turns it around, rate cuts become harder. Higher for longer becomes more realistic, and once higher for longer enters the room, the entire paper asset system feels the squeeze. Borrowing stays expensive, discount rates stay elevated, bonds stop feeling comfortable, growth stocks lose oxygen, housing financing stays stressed, recession risk and inflation risk begin arriving together. That is why energy shocks are so vicious. They do not just make life more expensive, they remove policy flexibility. That is inflation reentry. Now, let us move to the third mechanism. I call it paper wealth erosion. This is where most ordinary investors get hurt. They still think in neat portfolio boxes. Stocks grow, bonds protect, cash waits. But during an energy-driven inflation shock, those old assumptions can begin failing at the same time. Stocks suffer because margins tighten, financing gets harder, and the market starts discounting weaker future conditions. Bonds suffer because inflation pressure and rate fears change the value of fixed income. Cash feels safe nominally but loses purchasing power. In real terms, if inflation persists strongly enough, that is paper wealth erosion, the 1970s showed this clearly, the public thought they owned diversified portfolios. In reality, they owned structures built for a very different world. Once inflation and energy stress entered the system, paper claims were not enough to preserve real wealth. The headline balance could recover later. The purchasing power did not recover nearly as quickly. That difference ruins retirements. This is the part people miss when they look only at nominal charts. A market can recover in numbers. A household can still be poorer in reality. That is why I say paper wealth erosion is one of the cruelest parts of these episodes. It does not always look like collapse. Sometimes it looks like stagnation while life gets more expensive around you. That is still destruction. Now let us move to the fourth mechanism. I call it hard asset repricing. When paper claims weaken under inflation and energy stress, the market starts rediscovering things that are harder to print and harder to narrate away. That is hard asset repricing. Gold is not just a shiny story. Silver is not just an old relic. Commodities are not just tactical noise. In the right conditions, they become the few assets in the room that are not somebody else's promise at a fixed number. That is why they behave differently in these regimes. Gold reprices as trust in paper weakens. Silver can move even more violently because it carries both monetary demand and industrial importance, energy-linked assets, resource producers, and some forms of real infrastructure begin acting less like boring sectors and more like balance. Sheet protection, the public sees a commodity rally. The serious investor sees confidence moving out of paper promises and toward harder claims. That is the real shift. In 1973 and the years that followed, the move was not just about people getting excited about gold. It was about the monetary order itself losing credibility fast enough that gold and silver had room to reprice dramatically. Hard assets did not become magical. Paper simply became easier to doubt. That is hard asset repricing. Now let us move to the fifth mechanism. I call it ratio signal. Most people watch the obvious price and miss the relationship that tells the deeper story. That is ratio signal. One of the clearest warning systems in periods like this is not just the price of gold or oil by itself, but how they move relative to one another and relative to paper assets. When gold begins moving aggressively while energy stress is building, when silver starts responding to both monetary fear and real supply pressure, when inventories tighten and paper holders get uncomfortable, these are not random cross-currents. They are the market hinting that the old pricing regime is weakening. Ratios matter because they reveal what the public narrative hides. A stock chart can still look calm while the oil-gold relationship is screaming stress. A central bank can still sound composed while hard assets are saying confidence is leaking. A portfolio can still look diversified while the wrong kind of exposure is dominating everything that matters. That is why serious investors watch relationships, not just headlines. The ratio is not magic. It is a pressure gauge, that is ratio signal. Now let us move to the sixth mechanism. I call it government delay. One of the most expensive mistakes ordinary people make is assuming the state will stabilize the problem quickly enough to protect them. That faith is usually punished. Governments are almost always late to true energy shocks, not because they are always incompetent in every way, but because by the time a visible response is politically unavoidable, the economic damage is already moving. Reserves are tapped, speeches are given, emergency measures are discussed. The public is told things are under control. But markets do not care about reassurance. They care about structure. If the root is broken, if the price is rising, if inflation is re-entering, and if confidence is weakening, then the response is already behind the event, that is government delay. This matters because investors waiting for official permission to prepare usually arrive after the repricing has begun. The government is trying to calm, the market is trying to survive. Those are different tasks. The prepared investor does not need the state to predict perfectly. They only need to recognize that official response is rarely early enough to preserve the purchasing power of the complacent, that is government delay. Now let us move to the seventh mechanism. I call it prepared transfer. Crises do not only destroy wealth, they transfer it. That is the part the public feels but rarely names. When paper holders panic, when retirees sell, when broad portfolios get hit, when ordinary savers realize too late that the old 60/40th logic is not built for an energy-driven inflation regime, then the people who already understood the structure move differently. They do not need to guess every top or bottom. They need dry powder, hard asset exposure, and emotional distance from the headlines. That is prepared transfer. The great fortunes in these periods are rarely made by the loudest people predicting disaster. They are made by the people who understood what the disaster would do to relative pricing. They owned what would be revalued. They avoided what would be trapped. They stayed liquid enough to add when others were forced to react. That is how crisis becomes transfer rather than pure pain. This is why history matters so much. Not because 1973 repeats tick for tick, because the same chain keeps trying to teach the same lesson when energy breaks the old assumption set. The ownership map gets redrawn, that is prepared transfer. Now I want to force the identity shift because without it this still sounds like a commodity warning instead of a real wealth philosophy. Stop thinking like a paper allocator, start thinking like a regime reader. A paper allocator asks whether stocks or bonds are cheap today. A regime reader asks what happens to paper claims when energy, inflation, and policy move in the wrong direction at once. A paper allocator sees gold and silver as optional accessories. A regime reader sees them as part of an ownership map that behaves differently when the monetary system is under stress. A paper allocator waits for headlines to confirm. A regime reader studies the transmission chain early, that is the stronger identity. Because once you think that way, this is no longer about becoming a doomsday collector. It is about understanding what kind of world your portfolio was built for, and what happens when the world abruptly becomes a different one. Choke point shock, inflation, re-entry, paper wealth erosion, hard asset repricing, ratio signal, government delay, prepared transfer. That is the sequence. And now let me give you the operating system plainly. First, take energy choke points seriously. A supply rout under stress is a macro event long before the official shortage is visible. Second, understand that oil shocks feed inflation back into the system and remove room for easy central bank rescue. Third, stop assuming stocks and bonds will always protect each other when inflation and rates move together. Fourth, treat hard assets as structural exposures, not decorative holdings. In the right regime, they change roles completely. Fifth, watch relationships and inventories, not just headlines. Ratios often tell the truth faster than public commentary. Sixth, do not wait for government reassurance to protect purchasing power. Official response is usually late. Seventh, build enough dry powder and enough regime awareness that you are not forced to sell paper weakness while harder assets are being repriced. That is the heart of it. The unthinkable is not that gold and silver could explode higher. The unthinkable is how many people will still be positioned as though the old paper world is guaranteed to save them. That is what history warns about. Now let me end where this really matters. You can keep assuming this is just another temporary geopolitical scare. You can keep trusting that inflation will stay tame enough, rates will stay kind enough, and the old balanced portfolio will keep doing what it did in easier times. You can keep treating hard assets as old-fashioned while energy, money, and policy are busy redrawing the whole map underneath you, or you can do the harder thing. You can study the chain. You can respect the regime shift. You can own some part of the world that gets harder to print when governments and markets start scrambling. You can keep cash for the transfer window. And you can stop preparing for the last cycle while the next one is already introducing itself. That is the threshold. Because when the system moves from comfort to repricing, the people hurt most are rarely the ones who knew the least. They are often the ones who trusted the wrong protections for too long. That is the mirror. Look into it carefully. If your current portfolio still assumes energy shocks, inflation, and monetary stress are all somebody else's problem, then whatever else is true, the next repricing already has a target, and that target is unprepared paper wealth.